Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing ROKU stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. ROKU manufactures digital media players for video streaming. ROKU has an advertising business and also licenses its hardware and software to other companies. It is the largest TV streaming platform in the United States. In 2019, it had 37 million customers with 40 billion hours streamed. Let's get started with the model. This is a large cap company, 45 billion market cap. They're trading at $3.57 a share, and they have 127 million shares outstanding. Let's look at the financials. The way you value a company is you forecast their future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has negative free cash flow in 3 to 4 years. Net income is a profit and loss on the income statement. It's revenue minus expenses. And they have negative net income every year. Their revenue is really strong. It grows every year from 400 million all the way up to 1.1 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is cost of revenue. Then the difference between those two numbers is their gross profit. And their gross profit increases a lot each year. It's up to $500 million. Then below that is operating expenses. And their operating expenses are higher than their gross profit each year. This is pretty common with a company that's aggressively growing like ROKU is. So they have negative operating income each year, which means they have negative net income. This is the company's statement of cash flows. The top line is operating cash flow. That's how much money the company generates from its operational business. Then you have capital expenditures. These are investments in property, plant, and equipment. So when you take operating cash flow minus CapEx, that gives you your free cash flow. And that's negative every year except in 2017. So since the company is not generating consistent positive operating cash flow, they need money from somewhere else to run their business. So they issued $131 million of capital stock in 2017. They were able to generate this much cash through their IPO. In 2016 and 17, they paid down more debt than they issued. But in 2018, they issued $99 million of debt. And I pulled this from their 10K. It talks about a Term A loan facility for $100 million minus the debt issuance costs. When a company issues debt, there's not much you can do besides understanding how much they issued and the cost of the issuance. And then you have to decide, was it worth it for them to issue debt? Do they actually need the money? Some companies issue debt just to run their day-to-day business. Other companies issue debt to acquire other businesses. And whenever you invest in a company, you want to make sure they have positive operating cash flow. And if they have negative operating cash flow, then they have to at some point generate operating cash flow, else you don't really have much of a business if it's always operating at a loss. This company did have negative operating cash flow in 2016, but they managed to have positive in 2017, 18, and 19. So even though they had negative net income, they had positive operating cash flow. The way you calculate operating cash flow, you start with net income, which was negative $60 million. Then you have to add or subtract the non-cash items on the income statement. They pass through a $15 million depreciation expense, but that's a non-cash item, so we have to add it back on the statement of cash flows. They also had $85 million in stock-based compensation. And part of operating cash flow is adjusting for changes in working capital. The company sold $110 million on credit. So they sold their products but didn't receive any cash for it. So that brings down their cash flow $110 million. But in future years, when the customers pay for the product or service, that will increase their cash flow. They also had a positive $88 million in accounts payable. This is when you buy something on credit. But of course, in the future, when they pay for it, that will detract from their cash flows. This is a really good sign, seeing them operate with positive cash flow, because even though it's small, but once they get bigger and sales increase, then their operating cash flow should increase at a faster rate. Let's look at a capital structure. They have $700 million of equity, $419 million of debt, but they have negative $96 million of net debt. Net debt is total debt minus cash. So they could pay down all their debt with the cash on the balance sheet and still have $96 million of cash left over. They have so much cash on their balance sheet from their IPO a couple years ago. And their WACC is 11%, which is a blend of the cost of equity and cost of debt. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $46 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $33 billion. We divide that by 127 million shares. And we get a calculated stock price of $264. They're trading at $357, so they're trading at a 35% premium. It's a sell according to the model. Simply Wall Street is at $159 a share, so they're saying the stock is even more overvalued than me. So you can see the stock price increased a little bit in 2 years, but the pandemic has really helped this stock because a lot of people are at home and they need something to do. Roku is a viable option. Last year, before the pandemic, I transferred everything to Roku. I saved a ton of money on my Comcast bill. If you invested $10,000 into this company when it IPO'd in 2017, you'd have over $150,000 today. And the stock has a pretty high beta. It's almost at 2, so the stock moves twice as much as the market. The 52-week change is up 156%, much better than S&P 500. And the 52-week low was 58, the high was 363. And the stock is trading well above its 200-day moving average and 50-day moving average, so it's on a major uptrend. And when the 50-day moving average crosses above the 200-day moving average, that's called the golden cross. That's a bullish signal. So there's about 5.5 million shares that are traded each day for this stock. And Yahoo Finance says there's 106 million shares outstanding, 109 million on float. But according to their most recent quarterly report, they have 109 million Class A shares and 18 million Class B shares. And Yahoo Finance is only including Class A shares. It should be including all the shares. And about 3/4 of the shares are held by institutions, so they're bullish on this stock. And a short percentage is fairly low, 4.35%. Roku was founded in 2002 by Anthony Wood. He owned a company called Replay TV. Roku means 6 in Japanese. This represents Anthony Wood's 6th business. In 2007, Wood was named Vice President of Netflix. Netflix didn't want to get its own streaming device, so they had Anthony Wood create one, letting him start his own company and funding it with $6 million. And Roku's operations were in Netflix's building. They subleased part of Netflix's office space. Their top shareholders are Anthony Wood, 13.5%. He's the founder. FMR, almost 8%. Vanguard, 7%. BlackRock, 5%. And ARK, 3%. Let's look at their financial ratios. The average PE is 12. The median is 14.5. PE is stock price over earnings per share. They have negative PE because they have negative net income. Price to sales is stock price over sales per share. They're at 40, so they're much worse than the median and average. Price to book is stock price over book value per share. They're at 65, also worse than the median average. The way you calculate book value per share, that's equity over shares outstanding. They have $698 million of equity, but they have $548 million of tangible equity. So they have $150 million of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They have negative interest coverage ratio. ROE is net income over equity. Negative net income, negative ROE. Current ratio is current assets over current liabilities. They're at 2.6, so they can easily cover their current liabilities. And more than half of their current assets are cash, and they have $332 million of receivables. So the company does have enough capital to get through the next 12 months. They did have negative $71 million of free cash flow, but they have $567 million of working capital. The company is growing at a pretty rapid pace, so I think their free cash flows should be pretty high in 2021, definitely in 2022. The best way to look at ratios to compare them to similar companies, I've done videos on Cineplex, Walt Disney, Discovery, and Genius, all in the same industry as Roku. And if Roku has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So the worst in all the price multiples. They have the highest current ratio of all the companies. They have negative ROE, but that's better than the average. They're lower in debt than the average, and they are a big company, but much smaller than Disney. And nobody in this industry pays a dividend. So to summarize, I do have them trading at a 35% premium because the stock price is so high. But if the company continues with its rapid growth, the sky's the limit. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.